Okay, so I think we're on. All right, so this is just going to be like, how do you read financial reports? Basically, when you're trying to either buy a stock or buy a another business, in case you later become a private equity investor. Yeah, I'm recording this. Then it's important to be able to understand what are you getting. Right? So let's imagine if you buy a car, you would need to know, what is the trunk space, how fast does it go, how fast does it stop, and maybe you care about horsepower and mileage, all that. So this is the equivalent. So the financial reports typically come in 3 different statements. You got the income statement, which is very small, and now bigger. And then a balance sheet and a cash flow statement. So difference is that income statement is also known as a profit loss statement. So that just means for the past whatever time period, how much money have I made on paper? When I say on paper, it's important because that doesn't mean it's turned into cash. So it doesn't mean that the amount of cash on your bank account is increased. It just means that, give you an example, let's say I bought a McDonald's. Right? So I thought that was a good business and it ran for a year. And at the end of the year, I bought another McDonald's using the amount of money that's generated from the first one, which means in my bank, I actually don't have any more money than I started off with, but I actually made 100%, so I actually had a fantastic year, but the amount of cash didn't increase. So that's, on paper, that will get reflected in your income statement, so it would show you got 100% return, but you don't actually have any more money in your bank account. The balance sheet is a snapshot. So that basically means at the particular day, how much money do you have, who do you owe money to, and how much. So that's basically just a freezing time snapshot. And then cash flow is actually how much money has gone in and out of your business. So that's, let's say that the difference between this and then the income statement, which is very easily confused. So it's in the cash flow, if you, let's say I borrow $1 million, cash flow would show that I increased my cash flow is $1 million because I just borrowed it. And my bank account had $1 million more, but doesn't mean I earned anything because it's still someone else's money. At the same time, if you paid off $1 million, that cash flow would say, negative $1 million, but I didn't lose any money because I reduced my debt by $1 million. So that's the difference between cash flow and income. Now, so let's go through each one. So people usually pay a lot of attention to this number, which you hear a lot, which is net income per diluted share, also known as earning per share, earning per diluted share. We'll get into what is a diluted share later, but this is the number that goes on to the financial headlines, like, oh, the earning per share has gone up 10% or whatever. Right? So that is the number that people pay attention to, but it just means that the meaning of it is quite simple. It's like the total amount of income divided by the number of shares. That's your earning per share. But actually, there's a lot of tricks that you can play to massage that number, which we can get into later. So actually, every single line has some tricks you can play to change it. But let's get through each of them first. So net revenue is just net revenue is how much did you sell. And I'm not caring about, how much, what the hell is this? Okay. Yeah, so that just means how much my clients have paid. That's very simple. Cost of sales, okay. Actually, I'm using a couple of companies as examples. So this particular guy is, I think this is AOE, so American Eagle Outfitters. So that's just a retail company. Right, so the second line, cost of sales, includes certain buying, whatever. How much money did you pay to make those sales? typically is how much inventory you sold. Or let's say in a case of Medallia, it would be how much we paid for the servers. To host the servers for a year, how much did we pay? And that would go into the cost of sales. Gross profit is the you subtract the second one from the first one, you get the gross profit. So that's profit without accounting for many other expenses such as building depreciation, salary to different people and stuff like that. And then you got the selling general administrative expenses. That's how much money you paid other than the stuff you sold to make the sales. So one thing would be like credit card processing fee. That would be one of those fees. Administrative expenses, your office admin, obviously that's going to cost. And your accounting department, your strategy department, whatever department you have that does not directly contribute to the sale is your administrative expense.
Let's say the store rental.
That should actually go into here. So you can see it actually also contains warehousing expenses, occupancy expenses, so that goes in there. But the rental for your corporate headquarters, which does not directly contribute to sale, that would actually go onto sales and administrative expenses. So that's the difference. But salaries for what people, right? So yeah, certain people that's why we have departments. Certain departments directly contribute to, let's say, ops in Medallia. That would be part of the cost of sales. But engineers, no. Engineers are accounted for under R&D, which is accounted for typically in SG&A. We call this SG&A. Restructuring charges. That's just if you bought another company, you want to have some kind of merging business, or you spin off something, or let's say you're changing the organizational structure. Typically, that should be very small, and you can see here it's very small compared to the net revenue, so it's less than 0.5%. If this is high, either you bought some really big partner, so let's say if Medallia bought Medallia Digital, that would incur some of this cost. Loss of impairment of assets. So you bought something that you thought it was worth some stuff, but it wasn't actually. So let's say you bought a car. At the end of the year, you thought, oh, the car is actually worth half of what I thought it was. It's different from depreciation, because depreciation you can account for. Let's say you would say the car depreciates in 10 years, for example. But at the end of the year, you said, oh, it's actually a shitty car. I bought a lemon. So I want to make that reflect, to make my balance sheet more in line with reality, and then you have to record that loss somewhere, and here is where it comes in. Depreciation and amortization, that's you bought typically some kind of fixed asset. If let's say you bought a machine that in case of AEO in this American Eagle Outfitters, let's say you renovated your stores, and then, but the thing only lasts, let's say, 5 years. In 5 years' time, all these things gets old, and you have to replace them. So you want to account for that, so that goes in here. In Medallia, for example, you buy some servers. The server will depreciate in 3 years, or maybe you bought these furnitures, they depreciate in 5 years. So you typically set a schedule. Operating income is basically top line, which is total revenue minus everything else, and that gives you the operating income. So if you get the top one and you subtract everything here, you will get the operating income, and that is basically how much earning you have generated by your actual business. By actual business, like if I'm in terms of AEO, it's a retail company. So how much money have I generated selling clothes, right? But they could generate money in some other way. For example, they rented the storefront, and then someone else really wanted that storefront, and then I say, okay, sure, I will let you have it, but you need to pay me $1 million. But in that case, I'm not actually in my proper business. I'm not in a brokerage, like rental brokerage business. So that would not go into the operating income. So operating income is very important in the sense that that tells you how good the company is at doing its proper business. Like if you're a software company, I don't really care, if you earn some via stock investment because I didn't really buy you to become a stock investor in that. So income before taxes, so basically that's just everything. Basically those two lines added up. Top line minus all the expenses plus random other income. Usually the random other income should be fairly small as a percentage, and then you can see here it's about 1% of the entire income, except for Yaokai, but that's beyond the point.
Where is operating income number coming from?
Operating income is top line minus everything here.
Okay.
So if you subtract everything here, well, actually no. You can't subtract gross profit, but all the expenses, because here it's kind of difficult to see, but in a proper profit and loss statement, it's slightly indented to make it easy to see. But essentially, this is you could interpret as this thing minus everything here. Yeah. And yeah, earning before income taxes is just that. Earning before income tax, then the provision for income taxes, like how much tax do I owe? I estimate I owe, and income from continuing operations is basically this income before tax minus the tax. So that's just that. Gain from discontinued operation net of tax, that's basically if I shut down some division and then I may or may not have made some money out of it, then that shows in here. Typically it will be either very small or zero. And then net income is how much money that you actually made. This guy is special in the sense that it does not have any interest expenses. So American Eagle Outfitters does not have any debt, so it doesn't pay any interest. But a different company would have interest expense. So then you basically have to subtract income expense before the before this line. So your income before income tax would have been lower because you just paid interest on things. And yeah. Here it's after tax, but income before income taxes, that's pre-tax. So you got a pre-tax one on this line, and then you got after tax one on here. That's yeah. And then yeah, so the rest of it is basically you just divide by the number of shares. And two things that you may want to. So here we got net income per basic share. So a basic share is a share that is held by somebody. The difference is you could have a diluted share. Diluted share is, for example, options. Right? So a bunch of us may get issued options, but these are not stocks yet because we never actually bought them. So the company technically don't have them issued to you. A common stock share entitles you to dividends, for example, if the company actually distributes dividend, but if it doesn't, then it doesn't really make too much of a difference. And the other things that contribute to the difference between the basic share and diluted share is if you have like a convertible bond. A convertible bond is a bond that can be converted into a common stock share at a preset price, and that would get reflected in that calculation. And then maybe you have like stock warrants and stuff like that. So those will all get reflected. And yeah, and then here you can see the how that is different. The diluted share is about like 2 more million than the basic share. So there are 2 million shares that nobody owns, but potentially could appear. So that's your income statement. Any questions in here?
What's the most important metrics on this statement if I were to...
There are 2 that's very important. Total revenue top line, and then basically this guy. So you got a top line and bottom line. You hear that a lot. That's where it comes from. Top line is your revenue, and bottom line is your earnings per share. And when people's the reason we care about top line a lot is that reflects how many more things that the company's selling. So let's say that it's especially important if you have a company that's not yet very mature. Basically means it's still growing, and it's growing much faster than the earning would be growing. For example, your earnings negative, right? So Medallia's earnings negative. Does that mean the company is worthless? No. Why is it? Because we have top line growth, and the top line growth will eventually bring about the economy of scale, which means we'll make money. So that's why it's important. And also, it's harder to manipulate. And then bottom line, obviously, that's what eventually goes like the earning that's attributable to the common stock shareholder. So if I am a stock shareholder, then the book value would actually increase by this much, by 1.17. The book value is the asset minus liabilities. Asset minus all liabilities, your book value would increase by 1.17. And yeah, so that's why those two numbers are most important. And obviously, when you're analyzing it, there are a lot of things that you have to look at, but we'll just say that take a look at those two numbers, and those would be the most important ones. All right, so balance sheet. Balance sheet is split into two. You got assets and liabilities. Assets are the things that you are entitled to, you own in a sense. Liabilities are the things that you owe to others. Right, so cash and the cash equivalents, you can just think about it as a cash. Cash equivalents includes things like commercial paper, treasury bills, and short-term, basically short-term credits that you gave to others that have very low risk of that will default. For example, treasury bill is less than 3 months of U.S. government debt. Hopefully, they won't go bankrupt. And commercial paper, same thing. Inventory, that's fairly self-explanatory. So how much, in this case, it's how much clothes you have. Right? But if you think about Medallia, it doesn't have an inventory, so it wouldn't show. There is no inventory. It does not exist. Accounts receivable is how much people are supposed to pay you for the stuff that you gave to them, that you sold them, but they haven't paid. So typically, you get a period of credit. So usually, bills are paid 3 months or 2 months after the goods are delivered, and that goes in here. So that's the money that you're entitled to. It's almost as good as cash, except it's not, right? So you can't use account receivable to pay your debt. You have to use cash to pay your debt. And the other thing is, what if the guy that you sold to went bankrupt? Then you are pretty screwed. But in that case, you're pretty high on the tier. So when the company goes bankrupt and then they liquidate the company, you're pretty high in this ladder. So you are like second in line to get your money back. So you're usually okay. Yeah. So the first, it's by law basically. The first one to get the money is employees. Employees are the first in line. Then suppliers are second in line, and the third one is bank loans. And then after that is bondholders. And then bondholders can have senior bondholders, second lien, and whatever crap. You can have different tiers, right? So the first one gets paid out, and then the second one gets whatever's left. If there's left more, then you just keep going down. And then when the bonds are all paid out, you get preferred shareholders. Preferred shareholders can have many different tiers as well. So you got like the first one paid out, and then in the end you got the common stock shareholders. So bottom of the tier is if you buy a stock, you're the one at the bottom. And then the good thing is, if you're one at the bottom, if the company grows, none of these guys will get anything. You get all the gain, and then you're the first to suffer all the losses. So basically, common share is the riskiest and also the most rewarding. Because if a company doubles in size, all the bondholders still just get the same payment. They don't get double the amount. All right, so here, prepaid expenses. This is quite pointless. Basically, it's like if you, let's say I paid some insurance, right? I pay it for a year, but it does not line up completely with the year. So, like I paid it for a year and I'm using it for the entire year. But when I reported it, that portion, where does that portion go? That portion goes in here. And if the company goes bankrupt, you're not gonna get any money back from here. Like you don't go to the insurance company and go, "Oh, I'm going bankrupt. I have 3 months left to give me back your money." You probably just, I don't know, you should probably give it up or something. So total current assets. So everything here is current asset. Why does that number differ? It's probably something else that's not. There's probably something else that's not recorded. But essentially, this is current asset is things that can easily be turned into cash. Then that's how you count it. The most important two in the current asset is cash and inventory, and then also receivable. Because for some companies, their receivable can be gigantic. It was the case for Medallia about a year ago. We had gigantic account receivables, and now we don't. So what it means is that you actually get the cash on your hand, and you have more options to do with the cash. So to sidetrack a little bit, a fantastic company is one that has a zero account receivable. Basically, everybody pays you in cash, and has gigantic account payable. So basically, you just don't pay people for long periods of time. That basically means that you're using everyone's money that's buying from you, and everyone's money that you are buying from. So you actually need less of your own cash to sustain your growth. But that's beyond. But it's just something. So yeah, basically, being a bully is good. And then this is fairly simple too. You got some property and equipment, so computers, real estate, cars. If you are a FedEx, it's probably your planes. If you are AEO, it's probably the building that you have, and then these furniture that you bought, and lights and all that stuff. Intangible assets. Sounds very weird. What is an intangible asset? Why is it intangible? Because it's bullshit. Because you can't get anything out of it. The thing is, intangible asset is either too high or too low. Right? So what does it mean? It means if I have a brand or if I have a patent, it is an asset, but it's intangible because you can't readily turn it into cash. And intangible asset also includes goodwill, which is the worst name ever. Like, goodwill really is just a plug-in variable. Think about that, right? We all know what a variable is. A plug-in variable is basically to bridge the gap between two numbers in here. And why does that come? Where does it come from? I buy a different company, and a different company, the book value, so the asset minus liabilities, let's say is $10, but I bought it for 20. Right? So I bought it for 20, but I have to balance the balance sheet. So where does the $10 go? So I overpaid $10. Where does that go? It goes into goodwill. So it's already bribes in the sense that it's just a plug-in variable. It's a thing to balance out your balance sheet when you buy another company. That's all. That's all it is. And the name suggests it's like, oh, goodwill. My will is so good, but no, it's bullshit. So no, they're not donating to anything. No, they're just overpaying. When they overpay, you get a.
It's always for overpaying for buying another company.
Yeah, it's always overpaying for buying another company. It's always another company. And so they frequently will write it down as well. So what happens is, for example, HP would buy some company for $1 billion. 2 years later, actually the thing is only worth $1 million. And what happens is your goodwill gets written down for $999 million, and that's what happens. It's very commonly like an accounting trick. It's very stupid, but
You can't tell from this line of the items depreciate?
These are not depreciating. Well, actually, they are depreciating. They're changing, but you can't tell from here. In their annual report, there will be detailed explanations on why this changed. But the rule of thumb is never even think about goodwill as part of the asset because literally it's not an asset. And when I say sometimes it's underaccounted for intangible asset, right? So think about IBM. The brand is worth something. I'm buying from IBM. I'm getting some kind of guarantee because of the brand, but that's not reflected in here. I can't just randomly increase, say, oh, my brand has increased by $5 million. I can't put it here. So that, and then Coca-Cola, right? That's a very good brand. It doesn't go in there. So the intangible asset either vastly underestimates everything or vastly overestimates everything, depending on whether the company did a lot of mergers or whether it has a good brand, maybe it has some patents. It's that. And deferred income taxes, that basically means I lost money in the past. And when I lose money in a year, the U.S. government would say, oh, well, you paid a lot, well, I actually need to pay you because you lost money. You made money, so you pay me tax. You lost money, I should pay you back. But U.S. government never pays you back. So what they say is, for the future, you can slowly consume this deficit. But you can't do it in one go, but there is some kind of schedule. So if you start making money, you pay less tax, and that's what's shown here. This is very important for things like banks. During the financial crisis, they all lost a shit ton of money, and they're slowly getting paid back. Basically, they're getting some of it back in terms of taxes. Other asset, wow, it just says other asset. If you want to dig into it, typically there was an explanation in the actual report, but you have to read the entire annual report to get that. So total asset is just sum of everything. Liabilities. Liabilities, you got current liabilities, the thing that's due in a year. So if you have to pay those things in a year, it goes into current account payable. It's basically the money that you owe to your suppliers. Typically those are 3 months, but different industries have different standards. Accrued compensation and payroll tax. This is kind of it's kind of frivolous in the sense that because I ended the reporting at a particular day that does not line up with the payroll days. All right, if I pay on every first of every month and the thing ends on the last of that month, so you basically have a month of liability that you have to pay to your employees. That's what it shows. Accrued rent, same thing. Basically, I pay rent in some kind of installments, and because of the cutoff is at some point that there is a portion that I'm supposed to have paid, but because of schedule, I haven't paid. Accrued income and other taxes, it's the taxes that I owe, that I would need to pay at some fixed time. Because I think IRS asks you to pay every quarter, but it does not necessarily line up with your financial quarters. Unredeemed gift cards, wow, this is very specific to AEO because they have some gift cards they sell, and if you sell a gift card, you get cash, but actually you owe them some merchandise. So that's that. Current deferred lease credits. Okay, so this goes into lease credits. It's a very small portion of the entire thing, but essentially a lease credit is when I rent a place, I tell the owner, say, I'm going to renovate your place, but it costs me money. So, and when I leave, you get the benefit, right? So they're like, all right, then I will reduce your rent by a certain percentage or a certain amount every month or every year because you did this renovation. And that's what a deferred lease credit is. And the deferred lease credit should show up in probably in other assets. Actually, no, it's not in assets. It's a liability in the sense that you will start consuming that credit as you go along, as you keep renting that place. So let's say in 10 years' time, you will have completely consumed that credit that they give you. They never paid you in cash. It's just like, for that period of time, I'm going to reduce some rent. It's a very small portion, but for airlines, that's actually a big one, because when they sign a contract with an airport, they'll say, oh, I'm going to build out the jet bridge. I'm going to buy the jet bridge. But if I leave, you retain the jet. I'm not going to take it away. So there's some deal going on. Essentially, they will reduce their rent by a certain amount until it pays for their jet bridge. That's the thing. All right. So other liabilities and accrued expenses. Well, again, you can't tell anything because you have to read the actual report. So total current. Just a reminder, this is in a year how much I need to pay. Non-current, or typically known as like long-term liabilities. In this case, this guy has very, very little of them, right? You can see the total non-current liabilities like 87 million only. Everything is in thousands. You have to multiply 3 zeros. But the current liability is very high. This is uncommon because a lot of companies have long-term debts, and that would go in here. And long-term debts in here would show that, like typically would go up to like 50% of your asset. And the other thing is, in here there will be another line that says current interest payment or something like that. Actually, it will say accrued interest something in on this line. But you can imagine, like, that's the interest for the period of time that I haven't paid yet. And shareholder equity. You can see preferred stock here is empty. Basically means that the company has not issued any preferred stocks. And then common stock is just common stock. This part is completely uninteresting in a sense, because all this is to balance out the asset part. So the asset and liability should always add up to 0. Well, they should cancel each other out. And from the company's perspective, every shareholder is a holder of their liability, because you literally owe them the money, because they are the investors. You owe them the money. But if you turn it around, thinking in investors' term, if you're the common shareholder, then this is your asset. And yeah, so that's basically everything. Contributed capital is how much money that actually was invested into the company. And then retained earning, this one is very confusing actually. So a lot of people think about retained earning, it sounds like a chest of money that is retained, but that's not true. Retained earning just means of all the money that has ever been generated in the life of the company, subtract out all the dividend payments, what is left? And typically that means this is the amount of money that's gone in. There's no depreciation of anything. Right? Imagine if the depreciation is $5 because my car depreciated by $5, and I paid out $5 to the investor. Another $5 just matches the depreciation. If the depreciation is actually more than then the sum of then the difference between the earning and the dividend, then actually the retained earning will go down. So that number could go down. And the retained earnings often would show negative for early stage companies. For example, Medallia's retained earnings for sure negative, because it has never made money since it took investment. It took the VC fund. So that would be very negative. But it doesn't mean anything. You don't really need to care about that. You care about that in some very specific circumstances, but usually it doesn't matter. And total stock share equity is just how much the owners of the company, the shareholders, are entitled to in aggregate. So if you divide this number by the number of shares, that's called a book value. how much equity is there per share. Equity per share is book value. That's basically it. All right. Any questions regarding this? Anything in here?
Every public company has to disclose this kind of information.
Yeah, every public company has to disclose it. They have to disclose all three reports. And before like 1930 something, you don't have to report cash flow, but you always had to report those two. All right, so cash flow. Cash flow is very important because it's the most difficult statement to forge. Not forge, to play tricks on. If you forge it, I mean, you can put random crap on it, but it's very easy to detect because cash flow it can be easily validated by your bank statement. Look at the bank statement. If it doesn't match your cash flow, then you're bullshitting me, right? And then the auditors will catch it. So you literally can't play tricks with this stuff. All right, so
bank statements are available for public?
no, but to the auditors.
Oh, it doesn't.
Yeah, but all the public companies will get audited.
Right.
So if you play tricks on here, the auditor will catch you. So you don't want to do that. So this is the most reliable source of information. Anything else, the assets, the liabilities, and all that stuff, a lot of tricks can be played, and they do play a lot of dirty tricks there. So yeah. Right. So the first line is net income, which is the same line that we saw in the income statement, the profit loss statement. So that, let's say here's 212,449. If you go back to the income statement, the bottom line in here is 212,449. So that's the same line. And what you do is, given that, you have to remove all the non-cash items, and that will give you the actual cash flow. The cash flow is basically the difference between the cash you had now than compared to a year ago. This is the yearly report. If you have a quarterly report, then it's per quarter. So yeah, income from continuing operations. The difference is only this line. Basically, if you shut down something, then it would either give you cash or take away cash. Depreciation amortization is a non-cash item that is added to the income statement. You can see depreciation and amortization. It's a non-cash item because once I bought the computer, even though it depreciated, I don't pay additional for the depreciation. So you have to add it back to the income to the earning to remove the effect of this item. Share-based compensation, same thing, because when you issue shares to executives, employees, it is an expense, but the company don't pay cash for it. Essentially, all the owners suffer a dilution because of it, and that's why it shows up in the income statement, but no cash. Again, deferred income taxes, same thing. I didn't pay it. I will pay it later, but it's non-cash. It's a liability that's non-cash. And foreign losses, right? Same thing. Like I had some. Let's say I operate in China. I have 6 stores in China. They make their revenue in renminbi, and then I have all the money in there. I have not converted that back into dollars, but there's a fluctuation, so it shows up here. But actually, there's no cash exchange at that point, so that doesn't care. Impairment assets, same thing. I wrote down something I bought previously, and I already paid for it, so it doesn't really matter. And now you have to add everything that's things that I did not include in the cash flow because those are, for example, account receivable, right? So your account receivable, increase in account receivable is will contribute to your income statement because I have more money that people owe me, but it's not actually money, so it doesn't get reflected in your cash flow statement. So, and also with the inventory, same thing. Like the increase in inventory would contribute to my income because that's part of my asset, but that's not cash. So I have to subtract any change in the inventory. So those are the changes in inventory, account receivable, and you got prepaid expenses. So these are the like insurance payments and crap like that, and other asset, whatever that is. Account payable, so how much money, if I have to pay people less, that's a earning in a sense, but it doesn't show up in my cash flow because it's a non-cash item. So basically, you reduce all the non-cash items, and then you get this net cash used for operating. So this is actually net cash flow for operating activities. So this is actually a very, very important line. That means at the end of this year, because of the business that you were in, how much more money that you end up with in your bank account. Right? So in this case, these guys had $300 million because they were selling clothes. And so a lot of companies will report positive earnings but negative net cash used in operating activities. And that is very common if you think about, let's say, Ford. I built a new factory. Actually, no, Ford is a bad example. Tesla would be negative, but Tesla's earning would be negative too. I'm trying to think. I can't think of it now, but they do exist, and typically that's a warning sign. Usually, it means that account receivable increased a lot, or inventory increased a lot. Right? Think about those. Account receivable and inventory all counted as assets, but if your account receivable suddenly increased 100%, but your revenue only increased 10%, who are you lending your shit to? Basically, you're selling stuff, but you're not getting money. So that's very dangerous, right? And then the other thing is inventory. Are you just piling in inventory? You building things that people don't want, and it shows up as income, but eventually, you have to reduce the price that you sell it at. So in the future, it will get reflected. So a very dangerous sign if you get net cash flow from operating activities to be negative and the company is only growing at a very steady state. If you're explosively growing, that makes sense. It makes perfect sense. Like, for example, if you got Salesforce, early stage Salesforce, or even Amazon, it could make sense.
Wait, can you go over the calculation for net cash?
That's basically this number, income from continuing operations.
Okay.
So that's the income from your main business, and then remove all these adjustments. So add everything in, and that's this number. So if you look at 212, and then you add on the 153, then you end up with 365. And these things are basically any non-cash item. If it increases, you have to reduce it. If it decreases, you have to increase it. So this number is super important. And then if someone plays tricks, you compare this to, let's say, revenue, or you compare this to earnings change. If they diverge a lot, it's a warning flag. Capex is Capex, something that depreciates over long periods of time. You buy a car, buy a new warehouse, whatever. And Capex obviously reduces cash flow. I have to pay for this stuff. And then here you got acquisition of stuff, long-lived assets. It's the same idea, basically. You can treat it as... It's very similar to Capex, but it could be something that never depreciates. And then you got proceeds from sales of assets. So if I sold, let's say, if Medallia, let's say, sold Medallia Digital, that would be an asset I sold it. And if it increased, people would have to pay me. And then that's the money I get. Acquisition of intangible asset. So I bought some things that is intangible. Typically a brand, a new company, or basically just I overpaid for some crap. That would show up in here. And so this line, typically people only pay attention to this line, and it's usually the same on this line if they didn't make big purchases of new businesses. And then that's how much money you have to spend to either keep your business going or grow it. in AEO's case, maybe they spend money on making the stores more appealing to young people. Right? So that maybe they have to put different decorations somewhere, and then that would come in here. And maybe they invested in inventory tracking system that would come in here. Or they may have a new point of sale system that will come in here and all that stuff. Financing activities typically, as the name says, it's just some kind of money exchange. Typically, you either borrow or you pay back debt, or you pay dividend, or you pay interest. Those are the things that goes in here. And in here you can see that these guys are paying for capital lease. I'm not actually sure what capital lease is, but yeah, I have to check that. Repurchasing of common stock is basically how companies can buy back their own stock in the open market, and they buy it back and they retire it. Basically, they're saying if my stock is selling at below what I think is being sold, then I should buy it, because then I'm getting $10 of value for $8. I think it's a good business, so that's why they do it. And but that obviously consumes cash, so you have to reduce that. Repurchase of common stock from employees, it's the same thing. You basically let's say some of us bought a bunch of early exercise a bunch of options and leaves, and then you have to pay it back. Well, the company will buy it back, and then that's cash item. And net proceed from stock options exercise is the same thing. So some employees had some stock options and then actually pay the company to buy the stock. That actually goes in. So cash goes into the company that gets recorded. Excess tax benefit, some pretty miscellaneous stuff. Cash dividend, it's the amount of money that is paid out to shareholders. So shareholders get paid, the company reduces money. And this line is the total of all the financing activities. And the one thing to notice here is net cash used for financing activities. It doesn't matter if it's negative or positive. You have to look at it and see what it is, right? If it's positive, it's very likely that they're borrowing money from a bank, or issued some new shares, or issued some new bonds. So they increase their liability and increase cash at the same time. And if it's negative, very likely is that they generated more cash than they need, so they either use it to pay back debt, or they use it to pay back the investors, or pay the buyback shares. So this one, you have to look at like what they're doing with it. And this one is exchange rate. Again, you don't really care because there's nothing they can do about it. So if you have some money outside US and it changed, it's non-cash item. So you add it up. In the end, you got the net cash flow. So you can see that they had negative net cash flow for the past 2 years and positive one for this year. Is that a good thing? You don't really care, because very likely this is impacted by the financing activities. You can see the financing net cash is very, very negative for 2015, which explains the very, very negative cash flow for their net cash flow. Right? So the thing that's important in this one is the most important thing is net cash for continuing operations, the operating activities. So how much cash did you generate from the business that you're actually running? That's the most important thing. And then the second one is Capex. Typically, a company would have a consistent amount of need for Capex. If I'm Ford, I have to rebuild I have to buy new machines because machines get worn out. If I'm FedEx, I have to continue to buy trucks because they get worn out. So a steady business will have a constant need of Capex. And if you subtract, and then there's another number that's not reported in here, that's like the most important metric for a lot of people, is you subtract this number. Well, actually not subtract. In this case, it's just add, right? It's a negative number. You add this to the net cash for operating activities. That means taking out all the Capex, how much money do you have left? And capex, if you think about it, typically things that will get worn down in the future. So you can think about it as actually I'm not gaining anything from it. So that's called free cash flow. A free cash flow is very, very important. Yes. Any questions regarding this?
Regarding the new tech startup,
Yeah.
when public recently, what number did you get?
Oh, a recent tech startup on cash flow, everything will be negative. So what happens is they will get net income that's negative. So that's the first line that's negative. And then the depreciation, everything that they won't have much depreciation. A tech company, the main expense is cash expense, basically paid the salary of people. So they won't have anything that they can add in here. And in here, it won't be very different. Typically, the account payable will remain the same, but account receivable is actually going to go up. So basically, you get even more negative because you're increasing your sales. If you increase your sales, your account receivable will go up in line with your sales. If you think about it. If I sell $1 million a year, I have a 10% that I need to collect, 30% if it's 25% if it's a 3 month, right? But if I keep growing, then the amount of money I need to collect will keep growing, right? So the entire cash flow statement will be very, very, very negative, and that's expected. And that's the reason they went public in the first place, because they need the cash to grow their business. In that case, the most important metric is revenue. Like how much are you selling, how much more you're selling, and are you maintaining a good gross profit? Is gross profit growing really fast, and is your sales administration, SG&A, sales whatever crap and administration, is that sales, general, and administration? Yeah, sales and general administration. That number, is that relatively flat? Right. So if your SG&A is remaining fairly flat, your gross profit is growing like crazy, then you can see at which point the company will turn profit. But if you look at cash flow, it will all be very negative. But to start out, I don't think it's a good idea to invest in high-tech companies. It's much harder to analyze if you invest in a steady business that's not growing really fast. Yeah, you're gonna skip on the Amazons. But let's say you got Johnson & Johnson 20 years ago, you still made a shit ton of money. And they would be very stable, so you can use the cash flow statement to analyze like how much free cash they're generating. Any more questions?
So when you're like picking a stock, what are the numbers?
Well, when you
Give me a few numbers.
no, you cannot, because if it's that easy, then everybody will pick the same stocks, right? Clearly, people don't pick the same stock, and you care about different things. And then for different companies, you have to analyze them differently. If Amazon is analyzed in one way, and all the high-tech companies, and if you look at car companies, that's a different way. A airline is different, and insurance is different. They're all different. So you can't just say, oh, these are the things that you have to look at. But the purpose is that at least you need to understand the language that people are using. These are the languages people use, and what do they mean? And then you can formulate. Then you can understand what the business is doing. Because a lot of times people buy a stock, they have no idea how the business operates. How do they make money? Who do they pay? And do they pay a lot of interest because they owe a lot of debt? And you need to understand what the business is. And let's say if I look at Medallia, why I would buy the options. Like, how do I know this company is doing well? Well, I look at their statements, and then I say, oh, in this company, I can see it will turn profit because the gross profit is growing very fast, and all the expenses are fairly steady. We don't have any debt, so we have no debt. We're not going bankrupt. We are growing really fast, and that's a good sign. That means it will turn profit, and then that's why I buy the options.
Wait, before you buy the option, you're not allowed.
You can buy a single share.
Oh, right.
As long as you own anything, they are forced to give you the statements if you ask for it. But a single share, you pay I don't know $5, $10, and say I want the numbers, right? And then you can decide.
I still want to see the previous question. It's like, for example, previously when you see one stock, it dropped for about 10%, suppose it was 100 and it becomes 90. I remember that one. Remember you recommend us for buying that. And
Which one is that?
I don't remember.
Texas Roadhouse or something?
You remember he posts that in the WeChat?
Oh, AMD.
Oh yes, yeah.
Yeah.
Yes, and
that is
from 100 to 90, and what makes you understand that from 90 then is
this is to get in there is a lot more things you have to understand. So AMD is a turnaround story. It was shitty. It will turn around and start making profit. And typically, you don't want to start there if you're just starting investing. You want to buy steady companies. Because if you go there, you are betting on something.
So actually for AMD, you don't count on these short-term,
AMD, if you look at it short term, everything's negative. It's like holy crap. It's everything's negative. The earnings negative, cash flow is negative. Everything's negative. You don't want to even touch it. But
so what do you recommend us for buying it when it drops 10%? Because it may also drop 10% more.
Yeah, of course. That one you can run. You first have to come up with some kind of valuation. Right? How do I evaluate the company? Typically, you evaluate the company by how much money it can generate in the future. And this is the past. And the past is only useful to predict the future. Right? So a steady business, you can use this stuff to predict the future very easily because they grow 10% a year. You can see that they open, let's say McDonald's. They keep opening new McDonald's, and until they occupy the entire face of the earth, they will keep opening more McDonald's, and that will increase earnings. But in terms of AMD, it's because they have a new product, and the reason I wanted to buy it because the new product is very competitive, and that will bring them in a lot of money. That's not reflected in the financial statement for that quarter because it was only on sale for 10 days. It was only on sale for 10 days before the quarter closed. So you can't really tell much from it, right? So
how do you gain expertise in reading all these things? I mean, without getting too theoretical and bookish about it, I mean, what would be the most practical way of over a long period of time getting?
Yeah, but the main thing is that the goal is you want to understand what the business does, right? So if you think about it in a high level, a business has to sell something. It has to pay its suppliers, and it has to pay the creditors, the debtors, basically. The creditors, the banks, right? So that's the main thing. And what you need to understand is like, how much am I getting from selling my crap? And how much of that is profit? And then how much am I paying for maintaining this structure, which is the SG&A? And then how much is my cost in terms of finance? Am I paying interest and all that stuff? And then, is it going bankrupt? If I'm growing really, really quickly, imagine if Medada is growing like 1,000% a year, and then for some reason nobody wants to lend us money, and we exhausted our capital. What happens? You can't continue to grow because you have no cash, right? You can't buy more machines. I can't afford the machines to host the new companies. So, am I going to be limited in terms of growth rate by my cash? If I'm not limited by that, and I'm not going bankrupt, and I'm earning a lot of money, then it's a good business.
But then I guess my question similar is that how do you? So it's all about abstraction, right? I mean,
yeah.
And you gain these abstractions by going through an exercise of, working towards it, right? I mean, it's a sign of maturity.
Yeah.
Right. And your response to this, my question could be, hey, just read more and more news. But then
actually read more reports. All you need is like 3-4 reports from a single industry,
okay.
And you will understand that generally how that industry works. For example, airlines, they will have a lot of debt because they buy these planes, right? And a plane is very expensive, and if it's a shipping business, the same thing. You buy a lot of planes, so that's their characteristic. And then one of their major expenses is going to be fuel and the cost for financing for buying the planes. And then you got some of the employees and maybe the airport space. The airport, you haven't paid rent to the airport. So those are their costs. And then you have to...
So when you look at the airline industry, do you actually sit down and break these things down?
Yeah.
Okay.
And then that's how you can pick out the winner. If an airline... For example, Alaska is sold at like 14 PE, right? United is... PE is price to earning ratio, so the price of the share to the earning per share. And then United and American is sold at like 7 or 8. Why? Alaska has a lot less debt, so it pays a lot less. It's a lot less likely to go bankrupt. Even if you have economic downturn, they probably will survive. Right? And then Alaska is very profitable. Their gross profit is higher than all of these guys. And then they don't intend to even have a full coverage of the entire US. They only want to operate the most profitable routes. So they say, oh, I'm going to fly to Hawaii. But I don't really care about from, LA to New York. LA to New York is supposed to be very, very busy, but a lot of people compete, so they don't actually fly it. That's why they are very profitable, and then they have a higher PE. Southwest, why do they also have close like 12, 14? Because their cost is much lower. Why is their cost lower? They buy only one type of plane. Everybody else has different kind of planes. They got 747s or whatever crap. Southwest buys one kind of plane, 737. What does that bring? That means all your pilots can operate all your planes. All your flight attendants can operate all your planes, and all your jet bridges are the same. Right? So everything is the same. That reduces the cost. So that's why they have a higher efficiency, which is why they're more profitable, which is why they sell for more. And also they have lower debt. So you have to look at these things like where is their inherent competitive advantage? Southwest is lower cost because they do these things. And Alaska is better because they fly profitable routes. And maybe Delta is good because they have a refinery. I don't know. Delta actually has a refinery. They bought a refinery. Say, I want to lower my fuel costs. So they actually bought a refinery. And then Delta also buys old shitty planes for very, very little. So they will buy like planes that are like 10 years old and used planes for 20 cents or 10 cents on the dollar. And which is good because, it's cheap planes. So yeah, instead of buying the fanciest, newest planes, they buy shitty planes that they think is worthwhile, and that works. They bought MDs in like 5 years ago, and nobody buys MDs, but they bought them. So maybe Delta fetches a higher PE than United or American, and it's because Delta is a better run airline than both of them.
So you're saying higher PE is not necessarily a bad thing?
I'm saying that a lot of times higher PE is warranted because the business is better. The goal of a stock picker is to find a business that is well run, that has a lower PE than you think it should have.
How do I know what the right PE should be?
That we can get into in a later session. So how to value a business, right? I mean, first you have to understand what are the metrics, and then we can come up and value the business, and that is very important. So valuing a business, and then you find the discrepancies between the value and the price. Value is what you get, price is what you pay. If I get more than what I pay, I make money. I mean, I may not make money tomorrow when I sell it, but I'm getting a bargain, and that's a good thing. That's how value investing works. Obviously, there are other kind of investing. We can get that to those later, but yeah. Okay, all right.
Thanks.